Have you ever wondered why, despite having the best advice and strategies, some investors still end up making losses? Investment is a tricky business, and even the smallest of mistakes can sometimes lead to significant setbacks. But the real game changer? Learning from these blunders. So, let's dive headfirst into the world of investment errors, how they impact your profits, and more importantly, how to avoid them. Today, we'll explore 12 common investment mistakes even smart investors make, and what the Oracle of Omaha, Warren Buffett, has to say about them. Mistake number 1, not doing your research. Now, this doesn't mean skimming through a few articles or headlines. We're talking about deep, thorough research. It's like mining for gold. You have to dig deep to strike the vein. Think about Warren Buffett, a man who revolutionized investing. His secret? He understood the businesses he invested in. He dove deep into their operations, their markets, their competitive landscape. He didn't just look at the numbers, he looked at the story behind the numbers. He asked questions, he challenged assumptions. He made sure he knew the business inside and out before he put his money on the line. And that's what we should all strive for. No matter how enticing an investment might seem, never rush. Take your time, do your homework, understand what you're investing in. Remember, an informed investor is a successful investor. Mistake number 2, chasing hot stocks. It's a common pitfall many investors stumble into. The allure of the latest trending stocks can be hard to resist. But here's the thing, trends are fleeting, and so is the value they bring. When you chase hot stocks, you're essentially betting on the unpredictable, and that's not a recipe for long-term success. Instead, take a page out of Warren Buffett's playbook. He advises investing in solid, undervalued companies. Why, you might ask? Because these businesses often have a strong foundation, a proven track record, and the potential for consistent growth. They might not be making headlines right now, but their value doesn't hinge on the whims of the market. Remember, the stock market is not a sprint, it's a marathon. Quick wins might be exciting, but it's the steady, long-term gains that build wealth. So instead of getting swept up in the buzz, focus on the fundamentals. Follow the value, not the hype. Mistake number 3, trying to time the market. It's a tempting endeavor, isn't it? Thinking you can outsmart the market by predicting when it will rise and fall. However, the reality is, it's virtually impossible to consistently time the market with accuracy. Even the most seasoned investors would admit it's a fool's errand. Warren Buffett, one of the most successful investors of all time, has a different approach. He once said, "The stock market is designed to transfer money from the active to the patient." His advice? Focus on long-term gains instead of short-term market fluctuations. Why? Because the market has proven to be unpredictably volatile in the short run, but over the long haul, it has always trended upward. So by staying patient and holding onto your investments, you're more likely to see substantial returns. In the world of investing, patience truly is a virtue. Mistake number 4, ignoring fees. Let's dive into this one. It might seem like a minor oversight, but ignoring fees can seriously eat into your investment returns. It's like letting termites gnaw at your wooden treasure chest. Over time, those little bites can result in a significant loss. Warren Buffett, the Oracle of Omaha, has always advised considering all costs before investing. He likens high-cost funds to a hefty tax on your investment income. If you're not careful, you might find yourself sharing a larger slice of your pie than you'd like. So, how do you combat this? Well, it's simple. Be conscious of the fees associated with your investments. This includes trading fees, management fees, and even taxes. Always remember to factor these into your calculations when you're evaluating potential returns. Buffett's mantra is, keep costs low and profits high. And that, my friends, should be your mantra too. Every penny counts when it comes to your investment returns. Mistake number 5, following the herd. Now let's delve into the perils of herd mentality in the world of investing. There's a certain comfort in the crowd, but following the herd can often lead you off a financial cliff. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." This advice underscores the importance of thinking independently when making investment decisions. When everyone is rushing to buy a certain stock, that's often the time to be cautious. Similarly, when others are selling off in a panic, it might be a golden opportunity to buy. The herd mentality can create stock market bubbles and crashes. It can lead to overpriced stocks and neglected bargains. It's essential to keep your head when those around you are losing theirs. Remember, the stock market is not a popularity contest. It's a marketplace where value is king, and it rewards those who can think for themselves. In investing, the majority isn't always right. Mistake number 6, overcomplicating investments. Complexity and sophistication are often mistaken for a guarantee of success in the world of investing. However, this couldn't be further from the truth. More often than not, a complicated investment strategy only serves to cloud judgment and lead to unnecessary risk-taking. Let's take a leaf out of Warren Buffett's book on this one. Known for his straightforward and simple investment strategies, Buffett often advises sticking to what you understand. This doesn't mean limiting yourself, but rather investing in businesses whose operations and revenue models you can easily grasp. Remember, an investment is essentially buying a piece of a business. If you can't understand how that business makes money, you're setting yourself up for potential failure. So don't fall into the trap of equating complexity with sophistication or success. Keep it simple. Keep it successful. Mistake number 7, overconfidence. Now this is a tricky one. Confidence is essential in investing. It helps you make decisions, take calculated risks, and stay the course when things get rough. But there's a fine line between confidence and overconfidence. Overconfidence can lead you to underestimate the risks involved in an investment, ignore important information, or make rash decisions. Warren Buffett, the Oracle of Omaha, is known for his humility despite his extraordinary success. He's a lifelong learner, always seeking knowledge and understanding. Buffett's approach emphasizes the importance of continuous learning in investing. He's not afraid to admit when he doesn't know something, and he doesn't let his past successes cloud his judgment. Remember, in the world of investing, what you don't know can hurt you. It's crucial to stay humble, keep learning, and never assume you've got it all figured out. Confidence is good, overconfidence can be costly. Mistake number 8, neglecting diversification. Picture this, you're at a carnival, and there's a game where you have to toss a ring onto a bottle to win a prize. Would you put all your hopes on one bottle, or would you spread your rings among many? Investing is no different. It's about spreading your risks, not concentrating them. Warren Buffett, the Oracle of Omaha himself, strongly advocates for diversification. It's like having a safety net. If one company or sector doesn't perform well, you've got others that might be thriving. Think about it. The more stocks you own, the less damage any single stock can do to your portfolio. And remember, diversification isn't just about different stocks. It's also about different types of investments, stocks, bonds, real estate, and more. So let's heed Buffett's advice. Let's not put all our eggs into one basket. Because when it comes to investing, the last thing you want is to be left with nothing but broken eggshells. Don't put all your eggs in one basket. Mistake number 9, reacting to short-term events. In the world of investing, it's easy to get caught up in the whirlwind of short-term events. News headlines scream about market crashes, economic downturns, and the latest hot stocks. It's tempting to react, to make quick decisions based on these events. But remember, investing is a marathon, not a sprint. Warren Buffett, one of the most successful investors of all time, warns against this. He advises us to focus on the long-term fundamentals. Why? Because short-term events are often just noise. They're unpredictable, volatile, and can lead you to make rash decisions that veer off your investment path. Instead, consider the bigger picture. Look at a company's overall health, its growth potential, its competitive position. These are the factors that truly matter in the long run. Don't let the daily ups and downs of the market distract you from your long-term investment goals. Invest for the long haul, not the short term. Mistake number 10, not admitting mistakes. Now, it's a common human trait to avoid admitting our own errors. It's uncomfortable and often a blow to our ego. But in the world of investing, this reluctance can be a significant pitfall. Warren Buffett, one of the most successful investors of our time, has always emphasized the importance of acknowledging and learning from our investment mistakes. He once said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." The truth within these words is undeniable. When we admit our mistakes, we open the door to improvement and growth. We give ourselves the opportunity to analyze what went wrong, why it went wrong, and how we can prevent it from happening again in the future. So, rather than shying away from your investment errors, embrace them. Use them as stepping stones on your path to becoming a more informed and successful investor. Everybody makes mistakes, the key is to learn from them. Mistake number 11, ignoring inflation. Think of inflation as a slow-moving, invisible force that erodes the value of your money. It's like a thief that sneaks into your home and takes a little bit every day. You may not notice it at first, but over time the impact is significant. Now, what does this have to do with investing? Well, when you're calculating potential returns, it's crucial to factor in inflation. Warren Buffett advises investing in assets that can grow in real terms. This means assets that can increase in value at a rate that outpaces inflation. For instance, stocks of companies that can raise their prices to match or beat inflation. Real estate too can be a good hedge against inflation, as property values and rental income tend to rise over time. So don't let inflation silently eat away at your investment returns. Inflation is the silent enemy of your investments. Mistake number 12, not having a clear plan. This is a pitfall where even the most seasoned investors can stumble. Imagine setting out on a journey without a map or a destination. Sounds chaotic, right? That's what investing without a clear plan looks like. It's like shooting arrows in the dark, hoping one might hit the target. Warren Buffett, the Oracle of Omaha, emphasizes the importance of a well-thought-out investment strategy. He advises, don't swing at every pitch, wait for the right one. This means you shouldn't rush into every investment opportunity that comes your way. Instead, think, plan, and then act. A clear plan guides your investment decisions, helping you stay focused and disciplined. It assists you in navigating through the market's unpredictable waves and keeps you aligned with your financial goals. Remember, investing is not a game of luck, it's a game of strategy. So, plan your investments and invest your plan. So there you have it, the 12 common mistakes even smart investors make. Let's do a quick recap. 1. Not doing your research. 2. Chasing hot stocks. 3. Trying to time the market. 4. Ignoring fees. 5. Following the herd. 6. Overcomplicating investments. 7. Overconfidence. 8. Neglecting diversification. 9. Reacting to short-term events. 10. Not admitting mistakes. 11. Ignoring inflation. And finally 12. Not having a clear plan. Warren Buffett, the Oracle of Omaha, has advice for each of these pitfalls. Do your homework before investing, avoid the allure of the latest hot stock, don't try to predict market movements, instead, focus on the long term. Pay attention to fees and costs. Resist the urge to follow the crowd. Keep your investment strategy simple. Don't let overconfidence cloud your judgment. Diversify your portfolio. Stay calm and don't react to every market fluctuation. Admit your mistakes, learn from them, and move on. Account for inflation in your investment strategy. And lastly, always have a clear plan of action. Remember, these are not just mistakes, they are opportunities to learn and grow. Avoiding these pitfalls can set you on the path to successful investing. It's not about getting rich quick, it's about building wealth over time. Remember, as Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Happy investing!